Hi, the finance minister's announcement that Budget 21 will be like no other has created a lot of excitement and euphoria. At the same time, there's a concern about increase in taxes, considering that the government will have to spend money on infrastructure and sectors affected by COVID, such as healthcare, tourism, and hospitality. And the government doesn't have much elbow room with the tight fiscal situation. It will therefore be interesting to see how a balance is achieved. Today, we will talk about key expectations and suggestions on the direct tax side. Now, on the personal tax front, industry expects that the burden on HNIs will not be increased further, considering that the peak marginal rate is already close to 43%. At the same time, lower and middle income taxpayers expect a relief, especially due to reduction in their salaries in many sectors, impact of COVID and work from home, and a need to boost consumer spending through tax savings. Let's move to the business side. Now, starting with the infrastructure sector, representations have been made to ease tax laws such as through introduction of group consolidation rules, considering the SPV framework is common in the sector, and tax exemptions for private equity and institutional investors, both domestic and foreign, on the lines of similar exemption introduced for sovereign and pension funds last year. Now, there's a need to also amend some of the provisions in order to boost investment by sovereign and pension funds. Services sector is the backbone of the Indian economy. There's a need to reduce the corporate tax rate for services companies and LLPs and bring them on par with manufacturing companies. This will also provide relief to businesses which have been impacted by COVID. The government should also consider COVID-related relaxations such as tax break for CSR and employee welfare expenditure, increase in standard deduction or a special deduction for amounts spent by employees relating to work from home, and relief to foreign companies and expats in respect of the forced stay in India due to travel restrictions. On banking, there is a need to relax the provisions relating to deduction for doubtful debts by banks and NBFCs given the increase in NPAs, and to exempt NBFCs and insurance companies from the thin cap rules. Tax rates for branches of foreign companies should be brought on par with reduction in corporate tax rates. On the capital market side, various suggestions have been made, including introduction of a specific tax regime for Category 3 AIFs on the lines of similar regime for mutual fund investors, removal of the buyback tax, reduction in holding period for REITs, exemption against indirect share transfers for Category 3 AIFs and Category 2 FPIs, which pay taxes in India. At the minimum, I hope the government does not increase the capital gains tax rates. In order to further promote the GIFT IFSC, the government should consider setting up of sponsored funds such as NIF in the IFSC, introduce regulations to promote IFSC as a regional headquarter jurisdiction, extend the capital gains tax exemption to Category 2 and Category 1 AIFs, as well as extend the benefit of the 5% TDS rate to interest income received by IFSC funds. There is an urgent need to simplify tax administration. Authorities should be made responsible for efficient administration by introducing time limits for resolving appeals, rectifications, and refunds, speedy disposal of refunds, and allowing refunds to be offset against current year tax demands. Thank you.